Hello everyone, it's Janne Muta, Chief Market Analyst for TIO Markets here, and today we're going to spend some time with the news themes, news events or so-called risk events. I'm going to share with you how you can trade these better and how you can take into consideration the fundamental or the macroeconomic picture that's often behind these good trade ideas. So let's dive in, and this is going to be an interactive webinar, so I very much encourage you to put in your questions and I will find the answer if I can. So in a moment, actually let's just dive in and we can get going here. So first things first, we don't provide any investment advice. All this material is provided for educational and marketing purposes only. So just keep this in mind as we move forward with the ideas and analysis today. So basically, here's roughly what I've been doing in the past. I'm not going to bore you with the details. Currently, I'm here for you. That's what matters to me and hopefully to you as well. Basically, I have over 20 years of experience in analyzing and trading the markets, have been in both in retail and institutional side. So I've seen the dip business from different angles, and I want to share with something that I have picked along the line, over those years. I have learned quite a few things, so I want to share this with you so you can probably develop yourself as a trader a little better. So, first of all, you probably need some convincing. Why should you follow this webinar? Why should you basically, there's a lot of different people in the internet explaining that they are experts in the market. I'm making no claims as such. I just know that over 20 years I have learned a lot, and I can demonstrate my professionalism and my skills if you go to tiomarkets.com/analysis and read the past articles, you can see that quite often I do get the market direction right and the trade ideas right. I never obviously will achieve 100% success rate in that sense, but there are other ways of achieving 100% success rate, and we can talk about that later. But here's one of the venues that you can go and verify if my stuff is good or not. Go to tiomarkets.com/analysis and register for the daily newsletter or analysis report. You get it into your inbox, and then you can go to bit.ly/free-trade-ideas, and that's our Telegram channel where you can see my updates and some trade ideas. So I'm trying to find 1 to 5 good quality trading ideas per week, and obviously the markets are what they are. Then it really depends on the markets what I can post. But when I see something that is interesting to me, that's something that I regard as a high quality opportunity, I will post it there. Again, this is not investment advice. This is for you to support you in your own analysis. So never trade somebody else's ideas unless your own analysis agrees with the idea. So, trading the news events. This is going to be highly important, and I think if you don't follow all the webinar through, if you just have time for something, maybe few minutes only, then this slide you really have to pay attention to. And why is that? It's basically because a lot of people think that they can guess what the future is going to be like. It sounds silly, it's basically is pretty silly, but a lot of people do that, and they assume, we have to have an opinion. It's often that feeling that you have to have an opinion about the market beforehand. You have to have an opinion about the NFP or CPI release beforehand, and that's probably because the financial news media kind of requires that. But we're not talking heads in the television. We don't have to care. Nobody cares what we think about the market. The market certainly doesn't. So you shouldn't either. What you should do instead is to focus on something that you have an edge in. An edge means that if you execute a trade 1,000 times, it's likely that after the expenses and all the losing trades, after the expenses and after the losing trades, you still have a profitable result. And that is an edge. If you repeat something 1,000,000 times and it makes money, then you have an edge. But you can't have an edge with two unknowns in the equation. You don't know what the macroeconomic news release will be like. You might guess, but you don't know. Then you don't know what the reaction is to the news. So that's another unknown. If you have two unknown factors in the equation, there's no way you can solve it, at least in the trading world. So what that leaves us with is that bit here, price action. That is something that we know. Once we see that the price is trending higher, we know that there is a trend higher. There's no question about it. If the market makes higher highs and higher lows in series, then there's an uptrend, and there's no question about it. It's a simple fact. If the market comes to a support level and bounces higher from it, then that's a fact. Obviously, you never know beforehand exactly what's going to happen, but trading isn't about knowing things. Trading is about having the probabilities on your side. The probability is that if you have a significant support level and the market comes to it, then provided that the momentum is to the upside, the market is very likely to bounce higher from the level. That's what we are looking after. That's what we are after. That's what we are looking for. So stop guessing what the market might do if CPI is that or something else. If it comes in at 0.3% better than the analyst expected, what the market is going to do is none of your business beforehand. But once the figure is out, once the CPI value is out, and once you see what the price does, you are much better informed because you understand that, okay, this was the market's initial reaction to that number. This was the number. That's how much it deviated, if any, from the expectations. And you can see how it fits, how the data point fits into the trend of earlier data points. So once you have those two unknowns turn into two knowns, then you are much better prepared to actually trade the market. So yeah, okay, let's move on. Then just a couple of simple things here, really. If you have a news coming out that is anticipated by the markets, then it's obviously priced in before the event. And sometimes you see, for instance, banks coming out with some results and basically say that the result is a bank publishes results and it's really good. The results are great. But then what the stock price does, it flutters around a little bit and then starts to drop. And if you're a new trader, then you might start thinking, what's happening here? Why is this happening to this stock? The news was good. That was much better than expected. And it was much better than the previous result. And still, the stock price moves down. Okay, traders had priced in that better than expected figure. Maybe the analysts were surprised, but the market wasn't. Traders had actually already discounted this. They had already priced it in. and therefore all they had to do was to wait for the result to come out, and in that flurry of activity, in that increase in volume and trading volume, it's easier for them to exit the position because all the retail demand comes in. So that's just a simple example of what might happen. So there might be no significant market reaction, or the market reaction is actually the opposite than you expected it to be. Then new and surprising information, that's when traders do have to reposition themselves. And obviously there's huge investors, huge fund managers who are employing loads of traders, so the traders actually reposition what the fund is doing, or the fund manager's view has to change, and he communicates that to his traders. But basically the same thing. Traders are the ones that basically do the actual trading and repositioning for the fund. So if you see that they say a central bank, for instance, is expected to come out with a what would be a good example? Let's say that they're looking to raise rates by X, and that's the market expectation. And then the rate hike is actually 1.5 times X. That's a significant deviation from the expectation, and then traders have to reposition for it. And that actually can create a significant and often quite long-lasting market impact. All right, let's move on. So let's take a look how to trade risk events. And here we go. Just a simple reminder what those most important inflation measurements are. You have consumer price index coming out monthly, and also producer price index. And then the PCE, which is often called the Fed's favorite inflation gauge. So personal consumption expenditures is an important one, an important measure as well. And then obviously every first Friday of the month you get the NFP numbers, and there you have the average hourly earnings as well. So very important numbers, so that help you to understand what's happening with the US inflation. I'm going to talk about the inflation here quite a bit, because that's the topic that basically is basically quite, it's the big theme in the markets at the moment. There is probably nothing bigger, and everything is obviously interlinked to a certain extent, but inflation is a huge issue at the moment all around the world, so it makes sense to focus on it. So I'm using the US CPI month over month here as an example, and I've copied a few numbers here so you can see what's been happening with the CPI over the last few months. And on the right hand side I have the actual minus forecast, so you can see if there was a difference between the forecast and the actual number. So for a couple of months, April and March and April, there was no surprise, but then over these other months we had a bit of a surprise there, and that, as you can soon see, impacts how the market worked. Let's go there. So I'm going to go in a reverse order, so the latest month first. Like, with all the data, the latest figures are always most important. And this is a 30-minute chart in Euro USD. That's where the CPI was released. And a couple of things you notice straight away. Euro USD was weak already, as you can see from the moving averages, and I think these are 50 and 30. The fast moving average is 30 period, and the slower blue one is 50 periods. So you already had an existing downtrend in the market, And when the actual number was higher than the forecast number, and it was definitely higher than the previous number, that meant that the market moved quickly down in the direction of the trend. So you might argue that yes, here we had an opportunity to actually go short before the event, and a lot of people tell you that you shouldn't ever take a trade right before the release, and that's probably true. If you repeat the same strategy, same trade 10,000 times over, that probably means that you will have lots of losing trades, because you just don't know A, what the number's going to be like, and B, what the market reaction is going to be like. But at the same time, it's true that when you have the market in a downtrend and you know already that the US CPI is trending higher, then it's quite likely that the market will continue in the same direction. So you probably get shorting opportunities already up here. Just a very simple strategy for new traders here. If you use 50 and 30 period moving averages or something similar, it really doesn't matter if they are exactly the same or a little different. But if you use a faster and slower moving average as a trend indicator, and then look for overbought conditions in stochastics, like here and here, then you might have an edge on your side. If you just trade the right markets, trending markets, look for them, use the moving averages, and then wait for the market to move into overbought territory where you want to look for short trades. And again, this is just an idea. You should go and back test it first, either mechanically or using your own two eyes, and just study the historical price data. So that's something that a lot of people actually did, because the market can't turn lower there without a selling pressure. So a lot of people went short this market there after that small rally. So you might have an existing position going into the CPI release, but in this case, it would have meant that you already have some buffer in your trade. So if the CPI moves against you, you are not a weak holder of that position, of that short position. So, but instead, you are short already, and you just go through or hold your position through that news event, and then the market in this case moves further. But then there's another way of trading this. This probably happens very fast, this quick move here, and you might not be able to catch it just based on your reaction. Most often retail traders are not fast enough to get it right, and in the heat of the moment you just might just judge the situation wrongly and go long instead, or something like that. But it's actually better to wait for the market to have its reaction and then look at the circumstances. Now you have, once the market is here, you have a couple of things. You know what the inflation numbers are like. You know what the market's reaction to those inflation numbers were. And now you have three things going for you. You have the downtrend, you have the CPI that was better than expected and much higher than the previous number. So you would expect that Fed just keeps on hiking the rates to fight the inflation. So you have more reasons to stay short in Euro USD and look for more short entry possibilities. So you might just go into this, find these resistance levels here and short against them, or you might want to use a breakout strategy where you place a sell stop below this low and once it's triggered, you are automatically short the market. Then the market moves further, and you can see how the market hits the moving average quite often, and it acts as a sort of adaptive resistance there, and you can take more short positions there. So you don't have to have a position before the CPI release. You still have plenty of time after that, after the event, to take the trades. Then here's the May 11th. So that was a smaller surprise, but still the market, the CPI was higher than the forecasted, and yeah, it was much lower though than the previous number. But let's look at the price action here. First of all, the moving averages were kind of flatlined here, especially the slow 50 period average. So that tells you what? What does it mean? What do moving averages tell you when they are lined like this? In the middle of the prices, in the middle of the range, and you have very flat-lined 50 period moving average. What does it tell you? It basically tells you that the market is not trending, it's ranging. And it's interesting that now that the CPI release comes, the market stays in that range above this low. Okay, it creates a new low when the release is out, but the market stays in this kind of ranging situation for quite long, and then it starts to trend. So it seems to me that sometimes what you see the market doing before the release, it just kind of continues to do the same for quite some time before it starts to move. So here we go, the market moves down, and you again get similar opportunities. You can either use support and resistance levels, or you can trade against the moving average, or you can use, there would have been a nice opportunity to use the stochastics. But here's a very good point. Stochastics isn't your magic bullet. It is sometimes wrong. When the market has already moved down and then starts to react higher, there has to come a point when the oscillator is wrong. It's just inevitable. It happens. There's no way around it. At some stage, the signals will be wrong. So, okay, new traders might ask, what's the point then using these if they are sometimes wrong? That's what the market is like. Trading is like that. You don't have something that works 100% of the time. Nothing works 100% of the time. Except sometimes losing traders keep losing money 100% of the time. But if you look at some market measuring or analysis tools, nothing is actually perfect. And that's why you need the stops. That's why you never ever should trade without risk management. Only the traders with risk management actually survive, and sometimes are very successful. All right, so then I have third example here. This is from April, and the CPI release actually rallies the market quite a bit. So here we have the answer, why this happens. The answer to that is here. The actual minus forecast, 0. So basically exactly the same what the market expected. And then we get some meaningless fluctuation. Somebody could call this some people call this manipulation. I don't know if it's manipulation. There's no way of proving that. But the truth is that the market just runs up and then runs down and then continues in the right direction. So obviously there's ways to trade these situations too. Notice how the downtrend prevails though. You can see how the red is below the blue. The market is making lower lows, lower highs. So you have a downtrend. and that downtrend continues after the initial flurry of activity here. So one way of trading this is that you look at these, you try to identify a level where the market is likely to turn. So look at this range here. It's X number of pips. Then you can say, and obviously you need to go through past price data to establish whether this is something relevant to your style of trading, something that you want to do and something that works. But you can try to establish a multiplier for this volatility that precedes the release. So I haven't checked this, but let's say that it's 60 pips. So if the multiplier that you notice, say for instance 1.6 times the preceding volatility, i.e. 60 pips, so 1.6 times the 60 is your measure, something that you want to see the market moving at least that, and then you start shorting the market, believing that the trend will continue. This requires you need to create an Excel maybe, where you have different price levels in. First of all, you take this 60 pips, you multiply it by 1.6, and when the market has moved that much, if it moves, then you have levels there. Say that you have level 1, 2 and 3, and you scale into this position using those 3 levels. Then you have, if the stop isn't too tight, you have a good possibility of staying in the trade. Then another possibility is that once you see the market rallying higher and creating a spike, like we have this wick here, we have this candle wick. Once it has created some like this, you have some evidence of selling. If you go to smaller time frames than 30-minute chart, like if you go to 1 minute or 5-minute chart, you can see the market rolling over there, and then you start selling the market bit by bit. So the first approach is selling when the market moves higher and higher, betting that it will turn lower, and obviously you have a budget for this trade. You decide that I'm not going to risk more than 2% of my trading account on this trade, and if the market just continues higher and hits my stop, then so be it. Then the other option is to wait for some signs of weakness there, and once you see those, you start selling, first a little, then a little more, and then a little more. And in this case, you are actually selling weakness. You see your first sell making a profit, then you add another one. Once it makes a profit, you add a third one. The problem here though is that each time you sell, your average price comes lower, which means that the distance between your stop level and your entry, the average entry price, it increases. So in this first approach, your average entry price was higher and higher and higher after each new addition to your trade, and that can work better if you are very confident that the market will turn. But like with everything in the markets, you never have a free lunch. So you always have some risk in the game, and that's the reason the markets exist. Then we have a third way of looking at this. Here you have, after this candle, you have a lower high, which is often a signal that the market's going to continue lower, and in this case it does. So you could sell after the lower high, and then you have lost some of this potential there, but what you're losing in the potential, you are gaining in probabilities. So these are ideas that you can just toy with, you can study them, you can look at the past data and then decide what you want to do. All right. Then this was about, now those previous examples were about just news events, how to event trade. And this, here I want to talk about trading macroeconomic themes that last longer. So basically, recent and current macroeconomic themes are quite similar. So we have inflation, we have central bank policy expectations, recession fears, employment trends, COVID. Brexit is a bit of its history to a certain extent, but it's still reality in the UK. And the UK is still suffering because of Brexit, or the UK economy is suffering. And then we have the Ukraine war. So most of these themes are still present. They are still there. They didn't go away. And it's important to realize that these themes, or you could call them factors also, they're often overlapping. And that's what I mean by this interconnectivity, so that, you know, for instance, Ukraine war is creating inflation all over the world because Russia and Ukraine are both the top two grain producers in this world, and because Russia's oil and gas supplies are in key role in this war. So that creates inflation, and that impacts employment trends. That creates recession fears. That creates central bank policy expectations. So we have this overlapping and interconnectivity between these themes, but it also, each theme, each factor has a different impact multiplier. So that sometimes, before we go there, these impact multipliers, they have a time varying nature, meaning that the market will focus on one theme in a certain market more intensely, and that becomes the market driver. And some of the other factors, they are present, but the market focus isn't there. And this is something you learn over the years when you follow the news and follow the markets. You learn to see that, okay, this news came out, or this topic has been very much in the forefront in the financial news, and now that's why the markets are reacting the way they are. But then later on, the market, say DAX for instance, is driven into a major support, and suddenly, because a lot of the stuff is priced in already, a lot of the risks are priced in already, the market starts to turn higher and rallies. So the news theme is there, the macroeconomic background and the picture doesn't change, it's still there, but the market reaction function changes. Market just comes to a support where the line of least resistance is to the upside, and then it doesn't take a lot for traders to start focus on something positive, and the market moves in another direction, and it can last for weeks, and then the market comes down again. That's what happened with DAX this year. So how do we know what multipliers the market is attaching to each factor? Okay, we never know. We will never know. But what we do know is how the markets move. We can look at the price action and say, okay, market seems to be reacting to this news more than the others. And so I think because it created this downtrend from this resistance, I think the market is going to go lower now. So I'm going to technical analysis. I'm going to use the technical analysis to identify good spots to actually short this market. Okay, inflation and the USD. The mechanism how the inflation drives the dollar higher is here. Because the CPI is high, the Fed wants to fight the inflation and it hikes the rates. The Fed's funds rate moves higher, and that is bad for treasury bonds. So the T-bond market, or the bond market in general, goes down. That creates higher yields because they have this inverse relationships. If the bond prices go down, the yields go higher, and then you have a stronger dollar. That is obviously a simplification. There could be another central bank somewhere that is going to be more aggressive than the Fed, but lately it's been the Fed that has been the most aggressive central bank, and that has created a very strong uptrend in the dollar. Then inflation and stocks. Typically inflation means volatility goes up, and if you look at the 1970s, you can see that high inflation creates lower returns in stocks, but still there are those uptrend periods even in the 70s Dow chart or S&P chart. The market can trend higher, but the overall returns of that decade were very low. The market started to rally higher, I think it was 1982 or so. What happens between the different kinds of stocks? You have value having a relative advantage over growth stocks because higher interest rates means higher costs of financing, and though obviously if you have a growth oriented business that has to borrow a lot of money, then that's going to be a big expense multiplier for them, and that's why the market, because traders and fund managers know this, they tend to go into value stocks and sell growth stocks, and they don't wait around for the bad results to come. They just switch immediately. And then there's also uncertainty. Now, markets never like uncertainty, especially when your central bank has been saying first that there's no need to worry, inflation is transitory, we know what we do if there's going to be inflation, it's the deflation that's going to be the problem, inflation is never a problem, and then boom, suddenly we have 8% on annual level of inflation, and nobody's talking about transitory inflation anymore. So that creates uncertainty. It just shows you that the emperor doesn't have any clothes. Central banks, first, they couldn't create inflation for 10 years, even if they tried. And once they get inflation, they get too much of it and they can't get it down. So they really aren't in any control. But if you watch CNBC, if you watch some other news media, they kind of want to keep that illusion going that they somehow control the markets. Then inflation, gold, it's an old inflation hedge, but sometimes, like now, gold has been very vulnerable as the dollar rises. You know, the biggest gold market in the world is dollar denominated. The gold traded is valued and priced in the USD. And gold tends to suffer when the Fed reduces its balance sheet, or if there is no prospect of Fed increasing its balance sheet anymore. And I want to show you a couple of charts. Here we have, in the upper chart, we have the US dollar, and you can see how below here we have the US CPI. You can see how the CPI was rocketing higher already for quite some time before we had a major rally in the USD. This is the dollar index. The USD index, it's a basket of currencies. It's, I think, 60-70% of it is euro. But so what you see happening in DXY happens in the opposite happens in Euro USD. So inflation had been running higher for quite some time, and then the dollar penetrated the 93.07 level and really took off like a rocket. When you see something like this, when you see the dollar breaking higher, you have a decision to make, and that decision is, how do you trade this? If you go long the dollar, then you have to go short against then you have to short something against it. So is it going to be gold? Is it going to be equity indices, euro or yen? And a lot of times it's the Japanese yen that the traders used, because the Japanese society is aging. It's basically the Japanese youth and young adults just don't like making babies anymore. I don't understand. It should be fun. But anyway, they don't like making babies, and that makes the society old. That means that you don't have natural growth. It's going to be a big problem around the world, actually, but it's been a problem in Japan especially. And that's why the central bank just wants to keep the rates low, and I mean really low, close to zero. So if the dollar, if the Fed is going to raise rates aggressively, and the Japanese don't want to raise the rates at all, you know what happens. USD yen just shoots higher. So that might be an option for you. Gold, really, in this case, it's been an option to really, but it's not that good as yen, because yen has been trading higher, almost in a straight line. And USD yen has been trending higher, almost in a straight line, meaning that the USD goes up and JPY goes down. And then the stocks. Here it's interesting that even though we're talking about Nasdaq index, which is heavily weighted, which has a lot of those growth companies that are dependent on financing. A lot of this rally in Nasdaq, it was boosted, and actually a lot of this rally here also was boosted by companies buying their own shares, because the money was cheap or free. They just took loans and bought their own shares and propped up their results. And now, as the rates are going higher, it just doesn't work like that anymore. But here's a good reminder that you just can't go short based on this or the CPI going higher. You have to wait for the technicals, i.e. the price action, to give you the reason, to give you the confirmation that, okay, now here, from this point onwards, the institutions are selling the market. Now you can go into sell the rallies mode. But don't start selling the rallies when the market is trending higher. Market needs to be trending lower in order for you to make money. Some institutions probably started shorting here because they need to sell when the market is moving higher, because their positions are so huge. But you're not an institution, you're a retail trader. So you need to follow the market, not fight against it. So, rising cost of financing hits the growth companies. Levered buybacks of companies' own shares have to stop. Lower liquidity stocks are liquidated first, and there's lots of those in Nasdaq. And if the market just keeps on trending higher, retail traders should keep on buying until the trend reverses, and only after the bull trend is over, then you look for shorting opportunities. And you can have, obviously, for longer term positions, you can open short term positions. It just makes sense to have both in your sort of repertoire. Then here's what happened with gold. as you can see, gold hasn't really done much, even though the dollar has rallied. There was some upward pressure here because of the Ukraine war, but then gold kind of created a double top and has been trending lower since. So it's been much trickier to trade than the indices lately. If price action doesn't support your thesis, you need to stop trading and figure out what the institutional traders are focusing on. So gold can be an inflation hedge, but when the Fed reduces its balance sheet, it's not a great option. If the rates are going higher, it's not a great option. So even if you believe that gold is an inflation hedge, that belief needs to be subject to your observations of what the market does. All right, so we have spent an hour here together, and if you have any questions, we can switch on to Q&A now, and hopefully I can find some answers for you. There's, like I said before, there's a bit of a delay between me talking here and then you getting my voice and then replying. But let's see if you have some questions. I'm gonna wait a little bit and then we talk about what you have in mind, and hopefully I can find some answers for you. Okay, Shamena, thank you. Shamena saying, thank you, quite informative. Informative, yeah. Good. I'm happy that you liked it. I'm happy that this was useful to you. And actually, while the others might be typing their questions, please give me a rating for this webinar. So if it wasn't very good, give me 1. If it was kind of average, give me 3. If it was excellent, give me 5. So on a scale 1 to 5, how did I score in helping you via this webinar? So just type in that one number and then I have some feedback from you, which I highly value and appreciate, because it's my mirror where you can, that helps me to kind of see if I need to improve something or if you were quite happy with what I provided. Okay, excellent. Thank you guys. Thomas and Shamena are giving me 5s. I'm humbled. Thank you guys. Luke is giving me 5. Thank you. You are very generous today. Mafanela, thank you. Another 5 there. So Thomas is asking what kind of confluences you use to enter a trade. If I see a theme and the market following the theme, then I try not to fight the market. That's the rule number 1. And I go from top down. I see what the weekly market is, what the market is doing on the weekly time frame, whether the market is right at a key support level or right at a key resistance. And obviously then you know already that, if the market is at key support level, something that has been a significant support in the past, then it doesn't make sense to look for short trades. Because even if you get it right, the others might not see, especially institutional investors, might not see much profit margin there. So obviously you need to have profit margin, and you basically can think of this through the old axiom of line of least resistance. So if the market is at weekly support, then the line of least resistance is probably to the upside. So it is easier for the market to move to the upside. because it has taken a lot of selling to get the market to that support. So the sellers are probably exhausted themselves or have exhausted themselves, and then market is kind of it's easier for the market to turn around in that situation because there's not that much supply ahead. Then I look at the daily, if I can see the market making something, if there is a trend, for instance, in the daily. So if there is a daily trend that is just stair-stepping higher, then, and there's no extension, then that's probably a trend that is a strong trend and going to continue. Then I look at intraday supports and resistances, look at 4-hour, 1-hour charts and try to find the key support and resistance levels. My whole thesis is that, first of all, don't fight something like, Euro USD downtrend. It doesn't make sense to look for the low from that market. There's going to be, I'm sure you will find a low. You'll actually find a lot of lows. And just when you thought that you find a low, you have found a low, then the market rallies a bit and makes a new low. That's what the downtrend is like. And most losing traders, that's what they keep on doing. They keep on buying a market that keeps on trending lower. What professional traders do, they keep on selling the market that is trending lower. They sell the rallies, they sell the breakouts. They keep on taking the advantage of the big money flow out of that market. And that means, every market needs an inflow in order to move higher. If the market is moving lower, it means that money is flowing out of that market. So, first of all, don't fight the market, then go and see where the momentum is and where the key support and resistance levels are. And once you see in an uptrend market coming to a support, you can either start scaling into the position or you can wait for a confirmation, i.e. the price reacting to your level, which means that others were looking at the same level as you. And then you can use Fibonacci's. You can use, if you find moving averages and oscillators useful, you can use those, but you don't have to. And that's pretty much it. Try to establish the momentum, see where the market is trending to, and then find support levels that others might pay attention to also. If you look at two small charts, like 1 minute charts, 5 minute charts, you might actually focus on some very minor time frame supports and resistances, and then you just end up trading a lot and getting lots of false signals. It's better to go top down and see what the key levels are. Okay, so how does inflation impact the WTI? It's a good question. I can tell you what's been going on. Oh yeah. Thomas is saying that's a very good answer. Thank you. Basically, need to go with institutions. I'm using Fed's usually weighting 61.8 to 78.6. Yeah, that makes sense. Yeah, always try to find what the institutions are doing, because that's the bunch that moves the market. Retail traders really don't do that, so don't pay attention to them, because retail traders usually are almost without a fail. They are short uptrending markets and they're long downtrending markets. All right, so WTI, US oil. Let's see if I can bring up an oil chart. So it's nicer to talk about oil when we have something to look at here. Okay, here we go. So here we have 8 hours, an 8-hour chart, and oil is not a market that reacts to inflation as such. Oil is a market that impacts inflation. So if you have the market trending higher, that creates inflation. And obviously when you see this trend, you try to find places to go long. For instance, let me see. There's a level that used to resist the price move higher. When price came back to the level, it penetrated it only a little bit and then rallied up. That's an example of I think because I've been following oil quite closely in my analysis, so I think I wrote about this at the time. I wrote about this bounce. Then when the market is trending lower, it's inflation expectations are obviously decreasing because we have a market that creates inflation or decreases it, trending lower now. And then what you want to do is to look for rallies to short. Sometimes rallies are a little down market rallies are a little difficult. You don't see. Okay, there's actually a good example. Here's a level that used to support the price. Market rallied to it and dropped down. Then this here, you don't really see anything similar. That was probably a bounce lower from the moving average, even though it sounds a little funny, but sometimes the market just hits a moving average there and here, and okay, there it worked its way through. But yeah, they can act as resistances or supports as well. So oil, let's say that if inflation is such a big problem in different countries, it starts to impact the economic, the future of the countries. If the economic growth can't continue because of inflation, then oil traders start to factor this in as they factor in lower consumption based on lower growth expectations for the world economy. And that's basically what's happening here. So with oil, it's been a story. The Ukraine war has been a big story, and it's basically the expectation was that some JP Morgan, I think, was talking about $350 oil. And basically saying that if the EU leaders decided to ban Russian oil totally, then because there isn't that much supply in the world, even the Saudis don't have much in terms of supply, and that's why they can't basically add their production capacity and provide more oil, and that could have created a situation where the oil just rallies higher. Now it seems that oil traders are focusing on the downside, but at the same time we do have oil coming down to these important support levels here, so we might see some bouncing from here. Like now, oil is at this weekly low, and I don't think that's a good spot to go short oil, because we don't know. This double top and this lower high here could actually mean that the oil price comes much lower eventually. But let's see, if we make a projection based on this, say that there's a breakout, that would take the market down to these levels where it found support in August and November last year. So even though that is a distinct possibility after a lower high, market is still at a support. And when it's at a support, it can start rally higher. And we have some reaction here already. The market could rally a little higher and then roll over again, and probably that would be a better option to look for short opportunities. But yeah, that's what I'm seeing in oil at the moment. It's very much a war-driven, war news-driven market at the moment. So be ready to sudden changes and only trade what you see the price doing, because at the end of the day, that's the only known factor that we do have here. All right, guys. Oh, I need a break. It was great spending this hour with you, and some excellent questions. Thank you, guys. It was really good to be here. Sorry about the mess in the beginning, but you get the recording, so you don't really lose anything there. I'm gonna call it a day. Thank you for your marvelous feedback. If somebody hasn't given me feedback already, you can do that by typing in one number. It's something between 1 and 5. If it wasn't very good, you can give me 1. If it was excellent, give me 5, or something between. I really value your honesty, so I don't feel offended even if you give me 1. I basically prefer feedback to no feedback at all. It's always valuable. Shamena, thank you. Thomas, thank you. Mafelo, thank you. It was really nice. Prajas, thank you. Duna, thank you. I just want to finish with the word of the day for every trader, and that is never trade without stops. Always trade what the price is doing. Don't try to force the market, your own beliefs into the market. You just have to follow the momentum and follow the big traders, and that increases your chances of success tremendously. Okay, thank you, take care and trade safe.